Today we will be covering the chapter Enterprise, Business Growth and Size. We will be covering the benefits and drawbacks of being an entrepreneur, characteristics of successful entrepreneurs, contents and importance of a business plan, why and how governments support business startups, methods of measuring business size and their limitations, why owners may want to expand their business, different ways in which a business can grow, problems linked to business growth and how to overcome these problems, why some businesses remain small, causes of business failure, and why new businesses are at a greater risk of failing. So, now let's begin with entrepreneurship. An entrepreneur is a person who organizes, operates, and takes the risk for a new business venture. An entrepreneur brings together the factors of production in order for the production process to take place. For goods and services to be produced, there needs to be an entrepreneur. There are several advantages and disadvantages of being an entrepreneur. The first advantage is independence. An entrepreneur is independent. He is able to take decisions for his time and money and how to utilize these. He is also able to put own ideas into practice. If an entrepreneur owner, he or she is interested in a certain product or good or service, they can use their own ideas, own knowledge, experience into practice without listening to anyone. They can also become famous and successful if their business grows. Then there is a fame that comes with being an entrepreneur. You might have seen in the Shark Tank, entrepreneurs can become really famous. The business may be profitable and income can be higher than a job. In most cases, if a business is successful, then the income will be higher than a job. And they are also able to make use of personal interests and skills, which is very similar to being able to put own ideas into practice. Now, this is about the theme of their business. It could be based around their own interests. Now, let's discuss the disadvantages or drawbacks of being an entrepreneur. There is risk. A business can fail. Most businesses end up failing within the very few years of their starting. So, there is always a risk of failure. Then, capital or finance is required because running a business takes resources, so a lot of money is required to set up this business and for day-to-day running. So, owner needs to put in his own money and or find other sources of finance such as a bank loan. Then we have lack of knowledge and experience. Not all entrepreneurs have experience of running a business. Most new entrepreneurs do not have an idea of how to run a business. So, there is a risk or disadvantage that this is much more difficult than a job, because in a job you are taught what to do. But in business you have to use your own instincts and look at the market. There is also opportunity cost of being an entrepreneur. If there is a person who chooses to be an entrepreneur or to run his own business, then at the same time he will not be able to continue his job or go on to a 9 to 5 job. So there is a loss of income, because if he was not an entrepreneur, he would have been working at a job and earning an income. Now let's discuss the characteristics of successful entrepreneurs. The first characteristic is being hardworking. An owner has to put in long hours of work, especially in the initial phases of the business and even in the later stages as well. So, this trait is very necessary and very important in order for the success of the business. Otherwise, the business will fail if the owner is not hardworking. The second trait is being a risk taker. An owner or entrepreneur needs to bring together too many resources in order for production process to take place. These resources require capital and finance. And there is always risk involved that the business could fail or make a loss. The third trait is being creative and innovative. Nowadays, fashion and trend keeps on changing regularly. An owner needs to bring in new ideas, new products and new services and even new ways of doing things. So, this is a very important trait in order for the success of a business nowadays. Being optimistic means looking at the bright side. So, an owner always needs to look at the bright side realistically An owner cannot be a pessimist and say that no, it will not work out, it will fail. Because if you set yourself up for failure, you will fail. So you have to look at the bright side and plan accordingly. Being self confident. An owner needs to have confidence in himself. Otherwise, others will not follow him or be confident about him. Because a confident person could lead others towards success of the business as a whole. If an owner is in self doubt, then he is most likely to make mistakes and others will not treat him the way he needs to be treated. The next trait is being independent. An owner or entrepreneur will often find himself or herself in a situation where they can't depend on anyone else. They have to be there for themselves and take a decision based on their own qualities and decision making skills. And this is a very important trait. An owner cannot always depend on others to do things for him or her. The next trait is being an effective communicator. So, many people would have ideas in their mind or a plan, but if they are not able to communicate these ideas or plans to the bank, to investors or potential investors, then they are not likely to succeed. Now we will discuss about the business plan. A business plan is a document containing the business's objectives, important details about the operations, that is the production, finance, that is the money related stuff, and the owners of the new business, that is details about the owners. A business plan contains description of the business, which includes a brief history, summary about the business and their goals, aims and objectives. A business plan also contains details about the products and services, that is what is the business planning to sell or deliver to its customers. It could be either in the form of goods or in the form of services as well. It also contains data about the market, that is the market size, predicted growth, target market and competitors. You might have seen people talking about their business plan in Shark Tank episodes. The next is business location, area of the business as in office or the shop, and how the products will reach customers. This could be either through an online delivery app or something like that also. Organizational structure, size and layers of management as in who reports to whom with the levels of hierarchy. Financial information, that is predicted cash flow statements, income statements and statement of financial positions. We will be discussing about these in details in the upcoming chapters in section 5. The business strategy, as in how the business intends to satisfy customer needs and gain brand loyalty in order to make a profit and to increase the success chances of the business. Now let's discuss uses of a business plan. A business plan helps to gain finance. Banks will be reluctant to lend money without a proper business plan. And if someone has a proper business plan, so the bank is likely to offer them loan at decent interest rates. So business plan is very important for a business to gain investors and to gain loan from a bank. Also, careful planning reduces risk. I am not saying that a business plan will make sure that your business does not fail, but it greatly reduces the amount of risk, because if you do something with a proper plan, then you are most likely to succeed. Even if there is no guarantee, but the chances will definitely increase. The next topic is why governments support business startups. Governments will support new businesses to reduce unemployment in their country, because it is one of the macroeconomic aims of the government to reduce unemployment. That is, less people should be unemployed and more people should be working, because these people will now be paying taxes to the government, so the government has a benefit. Now government also needs to pay lesser welfare benefits to the unemployed, so government really wishes unemployment is low in their country and they try to achieve it. The second is to increase competition. Increase in competition or more producers supplying a certain product means that fair prices will be charged in the country for that product and producers will not be exploiting the consumers. The third is to increase output. An increase in output directly results in economic growth and increase in GDP. This increased output could also be exported to other countries, which benefits the country as a whole. To benefit society in the form of social enterprises. Some private businesses are social enterprises such as Eidhi or Silani, etc. etc. Now, the purpose of these businesses is not solely to make a profit. Even profit is not the main goal here. The main goal is to provide a service to the community, to help the people, and if these businesses make a profit, they reinvest it into the business. The new businesses can grow further and become large and important multinationals or big businesses in the future which pay a lot of taxes to the government, so government would always like this. Now these are the ways in which government supports the new business startups. It could be in the form of business idea, as in government could provide training to entrepreneurs that gives ideas about a business. Because gaining an idea that would be successful is very important. Many people would like to run a business, but they don't have proper advice as in what would be successful in the market and how to achieve success. So business idea is very, very important. The next way is through premises. The government could provide low cost premises with lower rent to start up businesses. Premises is like building. Finance. The government could also grant subsidies, as in helping new businesses for free, or they could give them low interest rate loans, as in they will have to pay lesser amount of interest on these loans. The government would do this especially in areas of high unemployment, so the government can benefit as well. Labor. The government could train employees or workers in a country to increase the productivity of businesses. Research. Government could provide research facility help in their own universities for businesses to use for free or at a minimal fee. Now let's discuss the methods of measuring business size and the limitations of these methods. The first method is through number of people employed, as in the number of workers a firm hires. The limitation of this method is that not all firms are labor intensive. Some firms can be capital intensive as they use more machinery in their production process and lesser workers. The second method is through value of capital employed. Now this is usually beneficial to compare businesses in the same industry that are capital intensive, such as oil extraction companies or similar companies. Now the limitation here is that not all firms use a lot of machinery. Some would be labor intensive. So the problem arises that if we were to compare Walmart to an oil extraction company, then this will be a very difficult comparison because Walmart would be labor intensive and an oil extraction company would be capital intensive. So we need to use multiple methods, multiple ways of measuring business size at the same time. The third way is value of output. Value of output method could be used to compare different manufacturing businesses in a similar industry to see which manufacturing business is producing highest dollar value of the output. So the more the value, the larger the business. Similarly, if we were to compare businesses in the retailing, that is the selling industry, we will compare them through the value of their sales. We should use multiple methods of measuring a business's size because one method alone is not enough. Now we need to write this in the evaluation of our answers. Now let's discuss why owners want to expand their businesses. They would want to expand their businesses because possibility of higher profits. Higher profit will mean a better standard of living and they could use these profits, reinvest them into the business and grow further. Usually owners with large businesses have more status and prestige in the society, so this could be their personal goal. Lower average cost, which is usually economies of scale, that is reduction in average cost due to a firm growing in size. We will study about this in detail further in the book, but for now you need to know that larger businesses have lower average as in per unit cost of production compared to smaller businesses because of multiple reasons. And they can also gain a higher market share. Higher market share means more growth in the market, and they would have an image of a market leader, or they could lead the market towards something. Now let's discuss ways in which a business can grow. There are two ways in which a business can grow, that is internal growth and external growth. In internal growth, a business expands its existing operations. For example, a fast food shop can open more shops in other areas using existing profits or a bank loan, but without adding more owners. In external growth, the business takes over, that is, buys out another business, or merges with, that is, works together with another business in a larger combined business. It is also called integration. An example would be that a fast food shop merges with, that is, works together with another fast food shop. The difference between a merger and a takeover needs to be clarified. So, a merger is when the owners of two businesses agree to join together to make one larger business, and these owners will now work together in the larger business. Whereas a takeover or acquisition is when one business buys out another business and only one owner will now be running the larger business. Now we know that integration means either merger or takeover. Now integration has three types: horizontal integration, vertical integration, which can be in the form of forward vertical integration or backward vertical integration, and the third type is diversification or conglomerate integration. Now I know this sounds a bit complicated. Now let's simplify this. Horizontal integration. Horizontal. What is a horizontal line? A horizontal line is a flat line on the x-axis. So this means that when one business merges with or takes over another business in the same industry at the same stage of production. Now let's clarify what an industry means and what the stage of production means. An industry means the area in which a business works. Like there could be textile industry or car industry. So in a horizontal integration, the industry has to be same, and also the stage of production has to be same. Stage of production means either the primary stage or the secondary stage or the tertiary stage. So all businesses should be in the same stage which are merging. That is, if a car manufacturer merges with another car manufacturer, what is happening? Industry is car industry and stage of production is manufacturer is basically secondary stage. So this is an example of horizontal integration. Next up is vertical integration. A vertical integration is also a line, but it is on the y-axis. So this means that when one business merges with or takes over another business in the same industry, that is, industry is the same like textile industry or car industry, but at a different stage of production. Means one business would be in the primary and the other could be in the secondary, or one could be in secondary and the other could be in tertiary. So if a business goes from one stage to the next one, that would be forward vertical integration. An example would be if a car manufacturer that is in the secondary sector merges with a car retailer that is in the tertiary sector. Now here industry is same, that is car industry, but a business in the secondary sector is merging with a business in the tertiary sector. So for this business that was in the manufacturing sector, it is forward vertical. And for the car retailer who is now merging with the car manufacturer, that is a tertiary business merging with a secondary business, this is vertical backward integration. The third type of integration is conglomerate integration, which is also called diversification. It is when one business merges with or takes over another business in a completely different industry. Now here the industry is different. Like a business in the textile industry could be taking over another business in the car industry. So that is diversification. In this example, we are using a car manufacturer merges with a hotel. Now these are completely different industries. And here the stage of production does not even matter because industry is different, and that is diversification or conglomerate integration. Now let's discuss the advantages of different types of integration. Horizontal integration. The advantages include reduces the number of competitors. So in horizontal integration, one of our competitors is now becoming part of our business. So it automatically reduces the number of competitors. There is also a reduction in average cost through economies of scale because now we will be producing or providing a service at a larger scale. And usually when a business operates on a larger scale, the per unit cost or average cost will drop. The combined business will also have a greater market share because two businesses will now be joined together, so automatically the market share will rise. Now let's discuss the advantages of forward vertical integration. Assured outlet for the product, because now whatever we produce will be sold in our outlet. Now we know where to sell the product. Instead of going to different shops, we know who we have to provide the product to. The profit margin made by the retailer, as in the seller, is now absorbed by the expanding business because now the retailer, the seller, is part of our business. So we will share all the profits made and they will not be exploiting us in any way. Retailer could be prevented from selling competitors' products. So we can ask our ally, that is the business we had merged with, to sell only our products. So that can be beneficial as well. Information about customer needs and wants can now be obtained directly because now the retailer is in touch with the customers. So if they need something, he can directly tell us and we can make the necessary changes. The benefit of backward vertical integration includes assured supply of important components. Similarly to having an outlet, now for backward vertical integration, we have an assured supply of raw material or component for our shop or manufacturing business. The profit margin of the supplier is also absorbed by the expanded business. As in now, the supplier will not be charging a profit from us, but we will be sharing the profits as a whole. The supplier could also be prevented from supplying to competitors. As in, we can ask our supplier to only supply to us and not to our competitors, so they may run out of supplies, but we don't. Cost of components and supplies can now be controlled because the supplier will not be exploiting us. The advantages of conglomerate integration or diversification include that risk is spread. If we are operating in multiple industries and one industry is failing or not performing as well, we will still be safe because now we are in multiple industries. Transfer of ideas. Even if the industries are not directly connected, there can still be transfer of ideas. Let's suppose a furniture manufacturer merges with a hotel. So the hotel can now transfer ideas about the requirements of the customers and what kind of furniture they like. Even if these industries are not directly connected, but these businesses can also help each other. Now let's discuss problems linked to business growth and how to overcome these problems. Larger business is difficult to control. This can be overcome by operating the larger business into smaller sections or smaller units with a different manager for each. Larger businesses lead to poor communication. This can be overcome by operating again in smaller units and also using latest IT equipment and telecommunications and having feedback. Expansion costs so much that the business is short of finance. This can be overcome by expanding slowly and using profits to fund further growth. Instead of going all in at once, we can grow slowly. Integrating with another business is more difficult because of clashes such as different management styles. When two businesses merge together, or even if there is a takeover, different style of management can cause disruptions and possible conflicts with the workforce or with other owners. So, this can be overcome by introducing a different style of management, by adapting. It requires good communication with the workforce, otherwise, it is very, very difficult. Now, let's discuss why some businesses remain small. The type of industry. Businesses in some industries, such as businesses which provide a personalized service or specialized products, will often remain small because if they try to grow, they will lose their competitive advantage, that is personal contact with their customers. Example would be hairdresser or car repair shop. The second reason is the market size. Some businesses will not have enough sales because the area in which they operate in would not have so many customers. So if they are located in a certain area, such as in a rural area, or they are producing something which only few people can afford, such as a luxurious car like Rolls-Royce, these businesses are likely to operate as small businesses. And the third reason could be owner's objective. Some owners would prefer to keep their business small in order to keep control and knowing their staff and customers, and also some owners want to avoid the stress of running a large business. Not everyone thinks alike. So owners can also have different objectives. Now let's discuss the causes of business failure. Lack of management skills. If the managers lack the appropriate skills for running a business and they take bad decisions related to the products, finance, or day-to-day running of the business, then the business is most likely to fail. Changes in the business environment. A business should always adapt to changes in trends and fashions and pre-plan. If a business fails to do so, then it is likely to fail. This happened in the case of Nokia, as it was a market leader for so long, but it did not adapt to Android, and now we rarely find any Nokia phones. Liquidity problems and poor financial management. This means that the business is unable to pay for its day-to-day expenses like wages of the workers, like suppliers, etc. So then workers might stop working, suppliers might stop supplying us goods or raw material, and we will not be able to function. Over expansion. If we spend too much money on expanding the business, we have very limited finance available for day-to-day running and for the management of the larger business. So this can also cause the business to fail. Why new businesses are at a greater risk of failing? Lack of finance and other resources. Well-established businesses will find it easier to gain bank loans or to reinvest into the business. But new businesses are most likely going to have limited finance and they will fail if they do not plan properly. Poor planning and inadequate research. New businesses often don't have the planning resources, the management, and research available to them for the success of a business. So they make poor decisions and they do not plan accordingly for the rapid changes in the environment or any similar things, and they fail. Lack of experience and decision making skills. New businesses will have new owners, new entrepreneurs who do not have market experience and they lack experience of running a business. So their decision making skills are not as good as someone who has been into the business for several years. So they make poor decisions and their lack of experience adds to that. So they are not able to run the business as a well established business. And that is it for this chapter. Thank you for watching.